LiteFinance, the world of financial freedom.
Hello, it's Monday 28th of August and it is the last Monday of summer vacation, which in terms of market volatility and action overall were very interesting. In fact, I can't remember when last time we had such lively markets during summer. I hope the beginning of September will prove to be even more wild when everybody will get back to work. Okay, so as usual we will check the calendar and then summarize key fundamentals this time for S&P 500 US index. So we will be moving around the US economy, where you might as well find some clues as for the dollar itself. Okay, so Monday is as always empty. Tuesday brings us a CV consumer confidence. On Wednesday we will get inflation data from Germany and US second quarter GDP. On a Thursday we will get Chinese manufacturing PMIs, Eurozone inflation data and US PCE inflation data. Finally, on Friday, PMI data from the biggest economies, Canadian GDP, and most importantly, non-farm payrolls will be published. So, the fireworks are saved for the end of the week, as you can see. Okay, so now let's move on to fundamentals. Financial markets are experiencing some tectonism. The Fed funds rate has reached the highest in 2 years, and US bond yields were last seen at the current levels in 2007. So it's unsurprising that investors have some alternatives to stocks. Net money outflows from the ETFs focused on shares have amounted to $11.6 billion in the past 5 weeks, and they will likely continue, allowing us to speak about the S&P 500's correction. A choice is simple when there are no alternatives. The epoch of the Fed's unprecedented monetary stimulus dropped bond yields to historical lows and pushed the S&P 500 to its record high in early 2022. Buying stocks was considered a sure option, which isn't the case now. 10-year bonds offer a 180 basis point yield premium over the dividend return from the stocks for the first time in 15 years. So even rates for investment-grade corporates are now more attractive than returns on stocks. Unsurprisingly, bond-focused ETFs have seen increased money inflows for 21 consecutive weeks, while money market funds have attracted $91 billion in the last 5 weeks, a 25% increase to $1.5 trillion, and the Fed estimates. Money market funds boasting the same reliability as a bank offer a 5.15% return on investment, a peak value since 1999. The epoch of the Fed's cheap liquidity is over, allowing us to say the stock market bubble is about to burst. It has already started doing that, actually. Still, the S&P 500 bulls managed to counterattack amid Nvidia's revenue growth by $13.5 billion in second quarter, further growth expectations to $16 billion in Q3, and EPS earnings per share coming in above forecasts. So the counterattack didn't last long. Stock indexes have one more structural problem besides 5% yield rates. A handful of AI-related companies allowed the S&P 500 to rise by 14%. The rest are not as bright. All the sectors included in the broad index were in the red area in August. What we see now isn't a mere correction of the stock market. It's a re-estimation of reality. It's about finding alternatives to stocks. If so, the pullback will continue. Whatever Jerome Powell may say at Jackson Hole, investors should understand that the Fed funds rate will remain high for long, which harms all risky assets from stocks to cryptos. Thus, selling the S&P 500 on breakouts at 4,563 and 4,547 at the beginning of August was a good idea. Then the index tries to touch the bottom at 4,360, allowing us to reverse and make money. Now we can return to shorts with a target at 4,300 and 4,265. And that will be all, guys, from my side. Thank you for watching, and till next week.